Jeff Lewis, Head Investment Services at JP Morgan Asset Management, joins in the show. Jeff, hi. Let's start off with your views on what is happening in the Western world, that is from India's perspective, and increased talks of further easing by the Fed as well as an LTRO3 as well. Do you think it's a possibility and an inevitable one at that?
It's certainly a strong possibility, and the Fed appears to have been encouraging markets to believe that there will eventually be a QE3. But I think that Bernanke will hold off for the time being. He'll want to keep something in reserve, perhaps towards the end of the year as we approach the so-called U.S. fiscal cliff. So I think the Fed is trying to achieve a difficult objective. It's trying to keep alive hopes of QE3, but without building up too much of an expectation that that markets will expect it to be delivered immediately.
Jeff, last time when we interacted with you on this forum, you were short-term bearish, medium-term confused, and long-term bullish. Have you changed your outlook?
No, I think we're going to see continued volatility, which will be driven by events in the Eurozone over the summer months. Unfortunately, I think different countries came away from the EU summit with rather different interpretations as to what that agreement has led to. And the foreign ministers' meeting has not really led to any clarification. They've put off all the difficult decisions regarding the ESM, regarding bank recapitalization, regarding movements towards a banking union until September. So markets have been trying to push the policymakers into speeding up the timetable almost to the speed of light by policy and institutional standards. And yet the policymakers, they're not willing to do that. So inevitably, I think that means continued financial stress, bouts of market volatility. And then, of course, we've got the U.S. presidential elections. Much will depend on whether we have an administration which is able to get its measures through Congress. And then we have the debate over the U.S. fiscal cliff towards the end of the year. So on that short-term outlook, it's difficult really to be too positive, except that I suppose a lot of this is now being discounted by markets.
Jeff, what is the global view on India? Because increasingly there has been a lot of criticism internationally on the underachievement on the government's part.
That's correct. There's been a lot made of this policy paralysis, and the government on that score, I suppose, has to be judged disappointing. And then we had unexpectedly weak GDP numbers. And yes, I think if looking at the portfolio inflows, looking at the foreign institutional and investor flows, foreign investors are not really pulling money out in huge scale. Some people see that as a vulnerability, but others see it as a continued vote of confidence in India's long-term economic prospects. And I think we would tend to be in the latter camp on that. So perhaps too much has been made of policy paralysis, and it won't take too much in the way of good news to actually see India start to recover. We are currently neutral in our global and Asian equity portfolios, having been underweight earlier.
So what will change your stance from neutral to overweight on India?
Well, I think that much will depend on the macro news. It will depend, obviously, on events in Europe to the extent that we don't want to see a euro breakup scenario or a deep recession there. But as long as that situation stabilizes, and if we see some improvement in the domestic numbers, the problem with India is that the inflation problem is more deeply ingrained than elsewhere, so it doesn't have the freedom of maneuver that other central banks, say the People's Bank of China, do with regard to easing policy to support domestic activity. So definitely there is a bind there, there's a policy dilemma, but some measures by the governments to improve infrastructure investment, to reduce inflation bottlenecks, I think that would be sufficient to generate renewed interest in India amongst foreign investors.
Jeff, whereas equity markets or global equity markets have held on very well, Currency is where the real problem is. The dollar index is at a fresh 1-month high, and the euro has plunged to a fresh 2-year low against the dollar. What explains the weakness in currencies?
Well, I think what we're seeing with the euro is that it was held up artificially earlier by repatriation of banking flows as European banks began to delever and retreat from their overseas markets. It's part of the solution for the Eurozone that we do need to see a weak euro, and we probably needed to see it to get down even lower, say to the 110 area. And that would actually be a way of creating some growth in the Eurozone, some of which would trickle through to the periphery economies. So in that sense, the currencies are adjusting probably in the way which we would want them to.
Jeff, at a point like this, what can be the role of Reserve Bank of India, and what trajectory do you think the Reserve Bank in India is actually going to approach from here onwards, because they haven't been cutting any rates so far?
That is correct, and I think it would be unwise for them to do so when inflation is still running at such high levels, particularly the new CPI index showing double-digit inflation. I believe they have been trying to help at the margins with some sort of signs of quantitative easing, of purchasing government debt. But in terms of directly cutting rates, I think they would resist pressure from the governments to do so aggressively. And I think investors would be rather worried if the RBI was to engage in aggressive monetary easing with inflation at such high levels.
Jeff, but is the world pricing in just too much of risk? Last night, the French bond auction was below zero. The German bond auction also last night was below zero. Do you think it's a matter of time risk will start opening up, because there is too much of global money, but too much of global money is now worried about capital protection, not capital appreciation?
Certainly it's risk off again, I think, after the very brief bout of euphoria after the EU summit, and then people realized that a lot of the intentions are not going to be easy to put into practice. So we are seeing continued flows of capital into so-called safe assets, safe haven, flight to quality, etc. And I think we're going to need to see more progress in terms of the Eurozone managing to stabilize its economy and get some growth narrative going. That is really the top priority. It's all very well to look at longer-term moves towards fiscal integration. The Eurozone needs some growth in the periphery economies now, particularly with unemployment at those levels, and investors are responding to that. I think one positive might be that the U.S. economy could do a little bit better than the consensus in the second half of the year. The U.S. economy is on a better growth trajectory. It has balanced the conflicting needs of fiscal consolidation, deleveraging better than the Eurozone. So that could be one bright spot, some signs of improvement in the U.S., together with some signs of increasing activity in China. Those two together might be enough to encourage investors to move back up the risk curve.
And in terms of equity market movement, Jeff, what is it, or rather, how do you see India panning out, given the global parameters and the domestic factors as well, which are at play right now?
Well, again, I think that these are probably reasonable levels for a longer-term investor, but in this very volatile environment, it's difficult to see the basis for a sustainable rally in Indian equities in the short term. So I think investors are going to have to be patient, and much, of course, is going to depend on macroeconomic events and policymakers' interventions. So this is a very difficult environment for bottom-up stock pickers. Markets remain macro-driven, and risk assets appear quite closely correlated. So this is a very difficult time for investors all round.